Hi, everyone. It's John again. It's time for a general market update. I'm recording this on Friday, April the 14th at 10:30 Eastern Time, a little earlier than usual because I'm preparing for the earnings reaction gap workshop, which is tomorrow. So as a reminder, this is a presentation by Rain King LLC, and I'm an amateur individual growth stock investor, not affiliated with IBD or MarketSmith. So the agenda is to talk briefly about the big picture. Then we're going to go under the hood and look at the market internals. We'll talk about the indices. And then I really want to spend the bulk of our time called doing the work, looking at a whole bunch of charts. So the big picture context. This is a monthly chart of the NASDAQ composite, looking at the monthly closes and some very long-term support levels in the index. I've been using this for 2, 3, 4 years as an indicator of the big trend. So we've been saying for a long time we can come back down to the 10,000 to 11,000 range and still be in the super cycle of a bull market. The 10,000 level being kind of a psychological support level that actually has held so far. So it's important to know that the low currently in the NASDAQ is 10,088.83, still holding long-term trend lines. This is the S&P 500. This is the chart I showed last week on April 7th. There really has been no significant change to the chart. It still shows that we're above the 10-week and 40-week moving averages, and the NASDAQ is actually outperforming the S&P at the moment, led by large caps. So let's get into the market indices. And before we do that, looking at charts, I just want to talk about this past week. We had the CPI report on Tuesday. There was progress in bringing down inflation, but it was fairly small, expected. It was a kind of a slow decline in inflationary pressures. The market was not too impressed with that. But we did have the PPI report, which was yesterday, which was a much more favorable decline in pricing pressures. The PPI tends to lead the CPI report because it deals with upstream pricing within the distribution streams. So that was actually a positive, much more positive report this week. Now we're going to start to get some visibility into banks. Banks are going to be reporting soon. The real question is, are we going to see more problems ahead for banks? It's going to be kind of a peek under the hood to see if banks are still in a strong financial position, which could help the market, or is there more weakness and signs of deterioration, which would be bad for the market? Now, the PPI report on Thursday did spark a rally in the market. So we had a subsequent follow-through day yesterday, almost 2% on the NASDAQ. Now, we've also had a subsequent follow-through day, March 31st of 1.7, and then a follow-through day on March 29th. So we want to respect that we're starting to see some follow-through, as choppy and as slow as it may seem. So let's go to the charts. Here's the S&P 500. I showed this last week. There's no significant change to the chart. Still 4,100 to 4,200 is a resistance zone for the S&P. We're in that zone right now, and this is actually intraday action as we're speaking. But the bigger trend is we are seeing higher lows. We want to see if we can push through and get a higher high to solidify a trend. This is the NASDAQ. As of today, intraday, you can see yesterday's follow-through day. And last week I said we could come all the way back down to the 50-day moving average in red and still see this idea that selling pressure is lighter. The first decline was fairly deep. The second decline was more gradual and less. And even if we came down to the 50-day. Now we got some support. So we're going back into this resistance zone for the NASDAQ composite. It'd be great if we could push through with some volume to show that there's some conviction. Okay, so let's go under the hood. This is the New York Stock Exchange, the net new highs, new lows as of yesterday. You can see that this has been a struggle. The banking crisis, the banks make up a significant portion of some of the S&P. So it really dragged us to net new lows with the bank weakness. But you can see in the last 3 weeks, there's been some improvement. we're at net new highs for some days, but certainly not at a level that's robust. Even the rally we had in January, you can see the number of net new highs was much more consistent and increasing, but this is improvement. Now, if we switch to the NASDAQ and the NASDAQ's new high, new lows, you can see that we have really, really still been plagued by new lows, net new lows. We haven't had net new highs in over a month in the NASDAQ. Though you can see, I put the NASDAQ 100 in the upper pane. You can see the NASDAQ 100 is still strong, but it certainly makes it vulnerable how far this market can go if we don't start to see net new highs. There really is not going to be a sustainable rally without net new highs increasing on the NASDAQ. You can see when we had the rally at the beginning of the year, more consistent new highs in the NASDAQ, and they were increasing as the rally was going. So this is not great yet. We have to just keep monitoring it. Things can change, but at the moment, the NASDAQ looks a little vulnerable with the NASDAQ 100. Going back to the NYSE, this is the advanced decline line and the percentage of stocks above their 200-day moving average. Here on the advanced decline line on the left, you can see there is some improvement of higher lows. We are approaching another resistance zone in the advanced decline line. We really need to see that push through, coincident with the index, the S&P pushing higher to make a higher high. So that remains to be seen. We are seeing some improvement in the number of stocks percentage-wise above their 200-day moving average. We are now at 60%. Which is improved from we were way down at 40 amid the banking crisis, but we're still not at levels that are really associated with bull markets. We want to see that above at least 70% to help us. So we need both of these to start pushing higher along with the S&P. So let's get into the doing the work section of this video. Really want to get into some charts. Now, before we get into charts, I just wanted to look at the Q1 report card. Those of you who've been following my videos, on December 26th, I did a market outlook and I suggested a number of stock ideas. So it's fair to look at these throughout the year. If you haven't seen this video, go back to YouTube and find it. Might be worth watching. But these are the picks that I made on December 26th and their prices. And here we are at the end of Q1. So what have we seen so far? Well, there's been a couple of big disappointments. Celsius and Enphase are really the worst performers in this mock portfolio. Both of them down substantially. You can see there was a gold pick that I identified that actually is doing well. But also there were some good picks. So far, so good. Impinj, SMCI, Shift4, Shopify, Okta have performed well in the first quarter. And then I did make a couple of what I call mad money picks, and I picked a couple of biotechs, which have not done so well in the first quarter. Now, if you total it all up, you say, look, almost 8% in the first quarter. Not too bad when you consider we went through a banking crisis and a real correction in the market. But, we're going to monitor this for fun to see how we're doing at each quarter during the year. So I want to come back to doing the work. This is about building your watch list. And, I think it's important many times to go back to weekly charts. Weekly charts will have less noise in them with intraday and daily fluctuations. And we always want to be focused on looking for signs of accumulation and the tightening up of price action. So there really are two situations of institutional accumulation. We want to look for stocks that are showing institutional demand already, which means these names have probably already been breaking out and they're either consolidating now or they're pulling back. And then we want to look for stocks that are where the institutional demand is still building. And by that mean there are bases forming. And we want to look at those bases to make sure they're proper in depth and some of the metrics behind them and that show that maybe they're under accumulation. So let's look at a few of these examples. Now, this is Rambus. I showed this at the February 3rd video, and I showed this as an example of an institutional accumulation signs. So it's worth reviewing again. These are the things you should be looking for. We want to look for a prior uptrend. We want to see a proper base, not too deep It meets the qualifications of whether it's a flat base, a cup with handle, etc. We love to see multiple up weeks in a row. 5 or more up weeks in a row is a very, very positive sign. Peak closes is good. 3 weeks tight. We want to look at that RS line. We want to see a breakout that came in on volume, big blue volume spikes. So we want to see these types of things when we're analyzing weekly charts. Again, from the February 3rd video, this was a quick assessment of trying to look at all those types of qualities, and I just took a basket of stocks and I just kind of ranked them after looking at them. I'm sure you can get your software to do a screen or do a report out, or you can do it manually with an Excel spreadsheet. But you should be looking for ones that are showing as many signs of accumulation as possible. So I call this stalking the semiconductors. This is the first situation I mentioned. These are stocks that have already broken out and they're already showing institutional accumulation. And we want to be looking for secondary ways to enter these leading stocks. So here's Allegro, broke out at the beginning of the year. And you can see this is actually the second week pulling into the 10-week line. Usually the first and second pullbacks into the 10-week line typically become buyable in a bull market. So what's nice about this one is the pullback weeks into the line have been on volume dry up. So that's constructive. Lattice Semiconductor. This is an interesting one. It broke out again at the beginning of the year, but we have nice steady accumulation. Look how tight this is, and it gradually keeps stair-stepping its way higher. That's institutional footprints. Again, first trip to the 10-week line and look at the volume spikes. The stock's under accumulation. So there could be an opportunity in this name. Excelis, again, broke out at the beginning of the year. This is the second pullback into the 10-week moving average line. And in this case, what I like about it is the stock essentially has moved sideways for 6-7 weeks as the line has caught up to provide support. 1, 2, and this is the third trip. And the volume's dried up on this last pullback. I see that as constructive. Now, I also wanted to go over, when you go through long grinding bear markets that last a year or two, the price action has to take time to gradually transition from sloppy bases to more tighter controlled bases that are showing these signs of accumulation. So here's an example of eBay after the .com bust. This is in 2002 and 3. You can see in yellow, this is a big, big, deep cup with handle, kind of wide price action. It's a big sloppy base. You can see in orange, finally the stock starts to build a second base, a little tighter in depth than the first one, but it's still not ready yet. And then in green, we can see that this base has really tightened up into more of a classic double bottom, tight price action. And look at the relative strength line in this third base in green. The base is going sideways, but look at the relative strength compared to the rest of the market. So this tightening is really constructive. So I thought it'd be good to just go over this template and what are a few names in the market that might be worth putting on your watch list. So this is Chipotle Mexican Grill. It fits the template with a big, wide, loose initial base. In orange, you can see it tried to form a little bit of a tighter base, a double bottom, and then the green base is this current cup that's being formed. So it fits the template in terms of trying to tighten up. The pieces that are not really in place for Chipotle, the negatives are no big blue volume spikes. So that doesn't show a lot of institutional demand. And the relative strength line is just going nowhere. It's going sideways. So this probably needs more time to really show all the signs of accumulation, but it demonstrates the concept of tightening bases. Here's Fortinet, FTNT. This is a much better situation in the sense that we have a sloppy base, then we have a base that's trying to get a little bit tighter at the bottom, and then you can see that look at the changing character over here. Look at these sloppy wide weeks. And all of a sudden, we get this large push, a nice volume spike, and then we get a nice, tidy little flat base, and it's starting to move up. And the relative strength line is already at a new high. As the stock is approaching new highs, we've got some blue volume weeks. So this is a much better candidate to be watching. So here's some more stocks. First Solar. This is actually an ascending base, which happens sometimes when you have a bear market. And it broke out, over a month ago. So this stock is, consolidating at the moment, something to keep an eye on. C Limited is a stock also that if you just look at this bottoming base, it had a base, it tried to break out on earnings. You can see some very large blue spikes of volume, and we're getting higher lows and higher highs. That's constructive. Arista Networks has been a leading stock. Again, concept of tightening bases, wide and loose, a little tighter in orange, and then a cup formed even tighter. And the stock is starting to really be strong, and it's pulling back now on low volume, which is constructive. So those are a couple names for the watch list. Here's the trade desk. The stock is forming a base, had a little prior uptrend, and it's forming this long cup with handle. You do have 3 big volume spikes, but the relative strength line is not really as strong as we'd like to see, but you might want to keep an eye on it. It's a stage 1 pattern. AMD, the semiconductors have been strong. You can see here, higher lows, higher highs. There is a lot of chunky overhead resistance in here, so there's some stuff we have to chew through. But semiconductors have been a leading group, and you can see there's 3, 4, 5 big blue spikes as a trend is starting to change to an uptrend. Floor and decor, you can see this has formed a big kind of loose base, but then it's forming a base on base here, which is much shallower, and it's still forming a little looser than I'd like to see. Volume's tightening up a little bit and drifting off, but something to keep an eye on. It's got the RS line that's within striking distance of new highs. So with anything, you got to be careful in the market and control your risk. The quote of the week is, if you hang around the barbershop long enough, someday you're going to get a haircut. Now, it's a cautionary environment right now. We're still looking for some real signs of accumulation and some volume, and the NASDAQ to broaden out its leadership. So sometimes the hardest thing to do is to do nothing until the time is really right. So take that into advisement for this week. That's the general market update for April 14th, 2023. Here's how you can reach me, and we'll see you at the next general market update.